Hi guys, and welcome to Chapter 6.
So Chapter 6 is all about internal controls in a financial statement audit. And actually, Chapter 6 and Chapter 7 really cover internal controls. The main difference is 6 is more about internal controls from management's perspective, while Chapter 7 is more about internal controls from the auditor's perspective. Before we really get into internal controls, I wanted to quickly talk about why auditors especially, but also managers, why we're so hung up on internal controls as accountants. Why do we talk about them so much? And the main reason why is we constantly are doing these surveys as to why fraud occurs. And very frequently, we see the main reason why fraud occurs is because there's opportunity for fraud. Right? When we think back to the fraud triangle, those places where there's opportunity because of internal controls, right? We see things like there's inadequate internal controls, or okay, there are internal controls, but they're being overridden, or people are essentially colluding to override them. And we know inadequate oversight is just bad internal controls, but at the entity level. So essentially, it all comes down to controls at the end of the day. So that's why we care about controls so much and why we're always talking about them. It's because they are essential in fraud prevention. They help mitigate agency problems, etc. In terms of defining internal control, this is the official definition from the company's perspective. And the definition comes to us from COSO, which COSO stands for the Committee of Sponsoring Organizations. And we have a little bit of history on that, which is actually included in Chapter 7 for some reason instead of Chapter 6. So we'll talk about it a little bit more next time. But essentially, internal control should be designed to help a company ensure that they achieve their objectives in these three categories: financial reporting, operations, and compliance. Right? Compliance in terms of making sure they're in line with laws and regulations. Operations, this is more day-to-day operations, right? Like making sure as a manager, I'm able to make good operational decisions. So if you're getting bad information out of your system and your system tells you product A is doing better than product B, right? So the system tells you product A is doing really well and product B is doing bad, but in reality, it might be the reverse, right? And it's just that your system is telling you this information, but the truth of the matter is product B is actually doing better, right? Has better profit margins, etc. And product A has less efficient product margins. But if I am going based off what the system tells me, I would be making inefficient decisions as a manager, right? I would say, okay, we're going to throw everything the company has behind product A, and we're going to start scaling back production on product B. So that's why these operational controls, making sure they're good, really helps to make sure you're being effective and efficient operationally. Financial reporting controls, this is what we spend most of our time talking about in this class, because that's what we really care about from an audit perspective, which we'll see on the next slide. So these are all the controls that are going to wind up helping us make sure that the financial reports are timely, accurate, reliable, the transactions exist, the transactions are complete, etc. So this is just reminding us that from the perspective of the auditor, what we really care about is the financial reporting controls. Okay? We don't care about the operational and compliance controls very much as an auditor. We care about them a little, but mostly in terms of actually how they impact the financial reporting controls. So we kind of care about them indirectly. Really, our main focus is on financial reporting. And what we'll see in Chapter 7 is for the things that we're actually required to give an opinion on, it's internal controls over financial reporting specifically that we give the opinion on. For public companies, it's not how are the company's controls in general. Don't think I have much to add on this slide in particular. It's just kind of talking generally about internal controls from management's perspective and what the system should do in terms of making sure assets and records are safeguarded and they're giving you good information to help you make decisions, like what we talked about before. And of course, for the auditor, we want to make sure that we understand the system of internal control, because we want to be able to do our assessment of control risk during our risk assessment procedures during our planning. That's what these 2 points are referring to. So we do our initial assessment of control risk, figure out, do we think it's low, moderate, or high? And then we'll use that to identify where we think, potential misstatements could occur, how we think risk of material misstatement is overall, which accounts do we think we should test controls over, which accounts do we think we should take the substantive approach we were talking about. AR control risk is low, so that means controls are good, effective, which means I'm able to have less substantive testing over AR. And when you actually get to the procedure of testing the controls, you may reevaluate some of these risk assessments. Maybe I think AR controls are really good, but when I actually test them, I find some of them fail. And so then I reassess my AR control risk to be moderate, right? And then I realize, hey, I need to do a bit more substantive testing. This slide talks a little bit about the role of IT and internal control, and it's basically talking about application controls and things like that. In terms of how this impacts our audit, you'll notice down here it talks about how audit firms spend all these resources trying to figure out whether IT application controls are reliable. What that basically means is most organizations have several different types of applications running various different procedures. So they might have one system that runs sales, they might have another system that's like their inventory management system that people are using out in the warehouses. They might have a PPE tracking system. So they might have several different systems that are kind of in play. We're going to have both an IT audit team and a kind of more general regular audit team coming out for each company. And what happens is the regular audit team actually spends time doing all the things we've been talking about so far. Right? We're planning, we're doing risk assessments, we're doing test of controls, we're doing substantive procedures. What the IT audit team focuses on is figuring out whether all of these applications are reliable and whether they're functioning the way the company thinks they're supposed to be functioning. And they'll do things like look at the underlying coding of all the automated application controls to make sure that they are coded properly and working properly. And if they discover that something underlying in the system is unreliable, it's really bad because we have to test the outputs of a IT automated system as if the control were manual. So, which means we have to test every single system output for reasonableness and reliability. So an example of that is I had one audit where our IT auditors every year, they always said all the applications were effective, right? But then we had one particular year where they came and they're like, okay, all the other systems are great, but the PPE system is having a problem. And actually, it was just with one particular control. They had kind of narrowed it down to one particular control, but the issue it was having is it wasn't calculating depreciation correctly. And so the problem was, normally if they tell us the application is reliable, we have all these controls like the system automatically calculates depreciation. And we only have to do a test of 1 if it's a automated control done by a system. We just have to do a test of 1, and because our IT people have looked at the underlying code and told us everything's okay, then we can move on after a test of 1. But because they told us that the system was not reliable, we had to test every system output, which basically meant we had to take the entire population of every depreciation calculation that happened that year, and we had to do random sampling over it. And we pulled out a random sample of 25 items, and we had to manually calculate the depreciation for book and the depreciation for tax over each one of those items. So you're basically treating the control as if it were manual, as in done by a human being. And this was no fun for us because probably you've taken tax recently, so you remember how to calculate tax depreciation. But all of us were several years out of school, or far enough out of school that tax depreciation was not something we remembered how to calculate. So we had to get a little bit of help from the tax director in terms of figuring out how to calculate that. So it's definitely worth it spending all this time figuring out that the systems are doing a good job, that the underlying way everything is coded is good, because then that allows us to just get away with doing these tests of 1 of these automated controls.